From New York City, for our viewers worldwide, very good morning. I'm Manus Cranny. These stock markets, they're just debating the field of dreams that is tech. $185 billion was wiped off the value of Meta in the past 18 hours. Is that a new message? We'll count it down right the way through to the open. We're 30 minutes away. Coming up on the show, big tech under pressure. This as the Meta earnings disappoint. Bond yields spike higher on signs of sticky inflation, and the US GDP delivering a downside surprise. Let me set the stage with the big issue. Growing concerns over big tech's outlook.
Earnings have been great, actually. I mean, not just for big tech, but also for, across the S&P 500. 80% of companies are beaten. All sectors are running, well ahead of expectations. The problem's the guidance. That helped with Tesla, and it's hurt with Meta. I think there's a message in there. It tells us that investors are nervous. It tells us maybe there's more macro uncertainty out there.
Well, let's get right into those results. Meta is the only stock that we've been talking about, but there are more issues in tech to deal with. Mandeep Singh is with me from Bloomberg Intelligence. So Zuckerberg chastised those investors who aren't smart enough to keep up with his capex.
Well, so he talked about a multi-year investment cycle, and I think that's where the comments were not very clear. What is he talking about? I mean, clearly the AI investments are working. It's showing up in the product. It's driving a lot of engagement and user growth. And in the end, the fact that they keep investing in Reality Labs, I mean, look, it may pay off, 5-10 years down the line, but nobody can see the payoff in the near term. And that's why I think you see such a strong reaction, because other than that, the print was great. I think the company is firing on all cylinders. The era of efficiency probably has passed. That's why you're not going to see that kind of margin expansion again. But look, they still have a phenomenal core business that generates a lot of cash. It's about what do they do with that cash. And right now they are investing in a lot of things. Some of it is good, appreciated by the market, and some of it is not.
And this is what Nancy Tengler had said to us this morning, which was he hadn't learned his lesson. Last year he cleaned up, cut down, refined the message, convinced shareholders about buybacks and dividends. As we cast forward, perhaps the case is multiplying for Microsoft a little bit more assuredly relative to Meta on the AI front.
I would agree. And look, Microsoft, the way they are deploying AI, it's reflected in their cloud numbers. We are probably going to see that tonight, at 5 to 6% growth or even more. Copilots. And in the end, there's so much opportunity with AI that why would you want to be distracted with VR, AR when you have so much to do on the AI front? And maybe, as I said, the payoff could be in the long term, but near term, you're going to see that with both Microsoft and Alphabet. They're emphasizing their cloud business and the AI agents and the ad side of it that they are deploying within their businesses.
Well, certainly tech is the field of dreams that a few were shattered on today. Mandeep, thank you very much. Let's continue the conversation. My guest this morning is BlackRock's Jean Boivin. Jean, it just wasn't supposed to be this way. The profits, amazing. The revenue, very, very strong. But the market heard from Zuckerberg yesterday, and this is what the market worries about in a higher for longer world. Spending too much on capex in a higher for longer world in a growth stock. It's just not convincing, is it?
Well, I think, we've been saying this year, pushing this year, thinking it would be a story of two parts. And at the beginning of the year, we had a very powerful kind of, narrative hope that we were going back to the good old world of the pre-pandemic with rates that would be ultimately falling to low levels. I think that has been recalibrating clearly over the last few weeks for many reasons. Of course, don't have to go into all the details here, but I think this is the broader story. And then this information flow comes from companies' earnings and so on, and that thing they're looked at now through a different lens. And it's a lens that, as you say, is probably one that we're adjusting to higher for longer. That said, we believe these mega forces like AI will be powering returns, and we're bullish on that. But it's the connection between that on the one end and this macro story that is evolving.
I mean, we're showing that very quote that you talk about, the year of two halves, supporting risk appetite. Resurgent inflation would come into view and disrupt that sentiment. That was something that was supposed to happen later in the year. You've just had the GDP and the inflation narrative in there. Underlying inflation 3.7%. That wasn't really what the market wanted to hear. Yields are spiking on that. Is the stickier and higher inflation something that you're having to deal with, which will dislocate risk appetite earlier than you had anticipated?
So the whole story of two parts was predicated on the fact that we thought there was some disconnect between the market hopes of everything is now getting into place in macro disinflation and what we thought was reality. We've been saying and believing that inflation would be bouncing back and ultimately, going into 2025, be more around closer to 3 than 2%. I think this is we've always been. Timing this is very difficult.
Yeah.
We thought there will need to be some accumulation of evidence for that to disrupt the market conviction. And, the central banks in particular, and I would say the Fed even more particularly, has been really underwriting this market narrative since December. So you needed that to change before you would see some sign of the market needing to adjust. But I think that has now accumulated more and maybe a bit quicker than we would have expected. And the Fed has changed much more radically, I guess, from December to March than maybe you would have expected. So, yes, I think this is a bit sooner than we would have expected.
And we are anticipating perhaps even more of a hawkish pivot, according to Bloomberg Economics next week, to undo some of that bullish, louche pivot that we had in December from Powell. Let's just return to the one alpha in the market this morning, which is about tech. It's about the expectation for Microsoft and Alphabet later on today. You went overweight AI, the winners and the enablers. As you look at the differentiation that's being struck now in Mag 7, which is Elon was believed, Zuckerberg was challenged, to Microsoft this evening, which is about a much clearer pathway to monetization earlier than the others, yes?
So I think the AI thematic, as you're saying, which as I said, we're bullish, and we think that, the world is bullish about that. The question is, where exactly will the profit be generated? And I think this is something we will need to continue to evolve and think about. But I do think that, there's some signs, and, all of these earnings over the last week have not been received the same way. We've seen pretty good numbers. But I think it's also interesting to see in some cases it's the intention to invest in the AI space that has been driving the story. So I think this is not simply just like AI. Any company in that space will work. I think there's more differentiation that is coming true now. Yeah,
it is about the nuances. I'm curious to know whether you're closer to a pivot away from U.S. equities. You say that you are overweight U.S. stocks. That makes perfect sense. You look at that GDP number this morning and the PMIs earlier on in the week, and we may have to caveat that. I just wonder, is that bringing forward the possibility of a pivot? You say the next 6 to 12 months, you're tactically long in the U.S., but you're ready to pivot. What provokes the pivot?
Yeah, I think this is... This is about how a big part has evolved, right? So it was about when will the market narrative, the hopeful market narrative around everything is falling into place, would be challenged. I think we've seen that being challenged now. And the other piece is earnings. Earnings, on the other hand, right, this year have been very strong and continue to support the market. So we've been approaching now this earnings season thinking about the bar being higher for earnings to maintain the bullish stance. So we're early in the season still. Some key numbers are coming out, but I think this is going to be key to whether we pivot, because the growth piece, the macro environment has evolved in a way that is more challenging. So now the question that remains to be answered is on the earnings front, and whether it sets the bar high enough to offset the more challenging growth environment. So that's what we're watching right now.
2-year yields have just gone above 5%. They weren't quite that generous when the auction was there just the other day. So we're seeing a little bit more fluidity come into the very, very short end of the curve. We saw the 5s go by nicely. Well, a little bit of a cheapening yesterday, and the 7s will come today. So it is going according to plan. My question to you is similar to others. Term premium, it's not as rich now as it was in the back end of the autumn. Is it approaching levels that are acceptable to you to take sovereign risk at 5% on 2s and 4.7% on 10s? Is the term premium sufficient, or does it need to be enhanced?
So I would separate here along the horizon. So on a tactical basis, on a tactical horizon, I think the volatility is extreme. We've been going like up and down, like I've rarely seen over the last few decades, right? So the response of rates or of yields to incoming macro data has been sustained at a level like we haven't seen. So that is makes I think making bets on yields I think more risky in this environment, and as a result, we're neutral on a tactical basis. You know, no high conviction. Can you go higher or lower from here over the next 2-3 months? I think this is.
So we've just lost Jean.
Further out, like on a, you know.
Sorry, Jean, we just lost your sign there for a moment. It was the drama at the end is what we missed. Just finish your statement again for us there. Sorry about that.
I was saying that like that was about the more near-term horizon. If you look beyond like over the next couple of years, we do think that long-term rates, 10-year yield will be closer to 5 than 4. So it's moving in that direction. We're still underweight, so I think that's somewhat more to go before we find that like a buying opportunity. But it's moving in that direction.
Jean, thank you very much. Well, one thing the traders at the moment, they've pushed back their timing for the first rate cut, Jean, to December. So incrementally, we're moving closer to that narrative of potentially no rate cuts this year. Did somebody say stagflation? Joining me now to take a look at the stocks ahead of the opening bell, Abigail Doolittle. Abby.
Well, we have to start out with Meta, and these shares are absolutely plunging, heading to the worst day in at least a year, with the stock set to lose $175 billion worth of market cap. This, of course, after they put up a great quarter, but the growth is not going to continue. The revenue guide in particular, disappointing. Plus, the talk of spending, as you've been talking about, on AI, a bit worrying. Now, after the bell, we, of course, have Alphabet and Microsoft. So Meta Platforms has now set up somewhat of a difficult road for these two companies. I would argue, though, that Meta up 130% into yesterday, a little bit of more of a high bar than either of these two companies. Nonetheless, down. Alphabet, a lot of look will be on their declining revenues plus AI. Microsoft Azure, the cloud component, it's expected to grow 28%. But we do have one bright spot, at least one bright spot. American Airlines up nearly 3%. They missed in the quarter, but their earnings guide is better than the street, and that has to do with solid summer demand, Manus.
Okay, Abby, thank you very much. Well, we just had the data. Coming up, the U.S. economy shows signs it may be slowing.
This is not a worrying report for the Fed. That is telling the Fed that those interest rate increases may be having some effect in slowing demand, particularly for goods, but it's not alarming by any means.
Don't be alarmed. Stand easy. Give you a snapshot of the rates market. You're showing an acceleration in the sell-off. Yields up 7 basis points on 10-year government bonds. This as the underlying inflation level comes in at 3.7%. And the rates market has pushed it back. No rate cut in the U.S. until December 2024. Right now on Bloomberg.
This is not a worrying report for the Fed. It's a report that says the economy continues to expand at a solid pace. Look at consumption growth at about 2.5%. This is a healthy consumer that is backed up by the claims data, where unemployment claims are low and job growth remains strong when you look at the payroll data.
Well, yields are spiky this morning after that GDP data. The 1.6% growth figure shows a significant economic slowdown in the first quarter amid persistent inflation pressures. And maybe it's the inflation pressures, Mike McKee, that this market is more irked by than perhaps the GDP number in of itself. Good morning.
Good morning, and my apologies for shrinking the markets and sending bond yields higher.
It's all you.
Not really my fault, but anyway, yes, we got a disappointing GDP number. It's not as bad under the hood as it appears. 1.6%, certainly lower than last quarter and lower than anticipated. Consumer spending a big part of that, 2.5% instead of the 3.3% last time, although 2.5% is still reasonably strong. Business investment hung in there. It It was inventories that did a lot of the damage, a much smaller inventory build than expected. Also, we had far fewer exports than expected, so net trade subtracted, and government spending, federal government spending, fell for the first time since last June, which may be because Congress pushed off the Ukraine-Israel military spend. We'll see if that shows up in this quarter. Jobless claims, as Blarina Ricci was just saying, surprising to the downside, 207,000 after a string of 212s. And so it looks like the labor market is still strong enough, and companies, even if they didn't have a great quarter, are not laying people off yet. That's going to make a big difference. Looking forward, well, let me just throw in, of course, as you mentioned, we had strong inflation numbers, 3.7% on the PCE quarterly core. Now, is that because it was revised in January and February, or because we're going to get a strong March print tomorrow? Right now, the forecast isn't for a particularly strong print. The headline is expected to rise, but the core is expected to go down. If it's because March was a lot stronger than expected, you could expect a big market reaction tomorrow. Incomes and spending, interesting that GDP was so weak for spending. We'll see if that 6/10 forecast holds up. And remember, this is all about the Fed. And the last comments we had from Jay Powell before the blackout basically said, given the strength of the labor market and progress on inflation so far, it's appropriate to allow restrictive policy further time to work and let the data and the evolving outlook guide us. And the numbers we got today, with higher inflation and still strong labor markets, guide them to do nothing next week. And as you mentioned, we have now seen the rates markets push out the first Fed rate cut to December.
Well, the bond market is, those two-year paper is up over 5%. Mike, thank you very much. A very clear, objective view of the data. Vishwanath Tirupattur is at Morgan Stanley. The short end of the bond market is not happy with this data. The long end of the bond market is not happy with this data. How do you interpret the pip higher in inflation and the drop in growth? Good morning.
Good morning very much. I think the bond market is reacting a lot more to the upside surprise in the inflation print rather than the downside surprise in growth. I mean, if you look at the growth numbers there, if the growth is, if you take away the effect of the stronger imports and the somewhat slowing down of the government expenditure and the inventory drag, the overall GDP growth picture is not that bad.
Okay.
It is showing deceleration, but what's more worrying for the markets is any sign of acceleration in inflation is worrying to the market, and that's what the market is reacting to.
I'm just looking here at the blog that we're running, which is the speed up in inflation is all about the services component. That rose at 5.4%, the fastest run up in the first quarter since last year. And that's what will immobilize the Fed, I think, to use your language. How immobilized or paralyzed is the Fed? Because the market has now decided that we're down to one cut in December. So let's just sort of have a truth and reconciliation moment. That's virtually no cuts for 2024, isn't it? It's a matter of time before we get there.
So our economists at the moment still have a base case of 3 cuts, which will be in line with what the Fed's dot plot suggests. But our economists did raise the point that any signs of reacceleration in inflation would make them rethink their view. So, I mean, we have been highlighting for some time that the risk of fewer cuts that arrive later is certainly a scenario that we have thought a lot about. And the source of that risk showing up is services inflation. And if services inflation, in particular shelter, and if we see upside surprises, if we continue to see upside surprises related to services driven mainly by shelter, that's something that we will have to rethink.
Look, part of the narrative as well, Bloomberg Economics, some great pieces this morning, talks about the pivot in December time that Powell delivered is responsible for a great deal of where we are now. And this is what they put forward as their thesis. Powell's pivot reversed much of the disinflation progress made in the second half of 2023, according to their model. It's boosted CPI by 0.5 percentage points so far this year, relative to a pivotless path, would therefore put the onus on Powell, because you don't get any new projections next week, to have a materially hawkish pivot. Well, to catch up with the market, he needs to, doesn't he?
I think it's a tough job. I think in communication from the Fed chair are going to be pretty challenging, and I would not underestimate the challenge difficulty associated with communicating that we need growth to decelerate, and we need the path of deceleration and inflation to continue, and the data dependency on the how monetary policy evolves. I expect that to be the point that the chair will reiterate, the data dependency, and there is a considerable. Let us not forget there is an enormous amount of uncertainty for the ahead of us. So I wouldn't pile on the Fed chair given the amount of uncertainty that is there.
Okay. I mean, it would be quite shocking if we did have sort of a vault face, but then if everybody was surprised in December time when we got such a dovish pivot. I'm curious to know what Morgan Stanley thinks is the biggest tail risk as we square away lack of rate cuts going from 7 to 3 to 2 to 1. But the IMF warned on energy prices. I know the war premium is dissipating now. What's your biggest tail risk?
I think reacceleration in inflation would be a significant tail risk. This is not our base case. Our base case is that we will see a gradual decline in the pace of inflation over the course of the year, especially shelter inflation. But our tail risk scenario is here. If we see significant reacceleration of inflation, that upsets a lot of the assumptions that we make. So I think from the markets, generally speaking, I think the markets, especially the credit markets, can handle fewer cuts that arrive later. Where the market's biggest challenge would be is if the next move is not a cut. If the next move is actually a hike, that would be very challenging outcome for the market. But
Indeed.
We think that the bar for the next move to be a hike is still very, very high.
Okay, Vishy, thank you very much. Vishwanath Tirupattur, they're my guest this morning on the markets. Coming up, your morning calls. Meta disappoints, raising the stakes from Microsoft and Alphabet. The results. We'll have Mark Lehmann with me from Citizens JMP Securities next. Morning calls for you. First up, Bank of America downgrades Decus to neutral, citing margin valuation concerns. Next up, Wells Fargo upgrades 5 below to overweight, highlighting compelling risk-reward. And finally, Truist downgrades Monster Beverage to a sell from a buy, seeing limited catalysts on the horizon. Now, if you've been hiding under a rock, you may well not have noticed that big tech is in focus, as well as rising yields. I mean, there is only one stock to talk about. It is Meta and the annihilation of equity shareholder value. We'll talk about that with Mark Lehmann next. These equity markets are stirred. You've got big tech under pressure, Meta really under pressure on their capex spend. That was the one punch. The two punch is the spike in yields. Two-year paper is above 5%. So you are looking at a real challenge to the growth narrative and indeed to the breadth narrative as we see these markets push rate cuts in the United States of America out to December of this year. This is what we've got for you in terms of the rest of the assets. You've got a stronger dollar on the back of the spike in rates. The euro is down by 1/10 of 1% at 106.88. The dollar is strong across the board. Rates are now really propelling higher, up 8 bips at the moment as the market reassesses on the back of the stronger underlying inflation in the United States of America, 3.7%. So whilst people are trying to explain this away, the slowdown and the spike in inflation, it is irking the bond market. Oil is up 0.3 of 1%. That just reflects back on crude inventories, which declined the most since January. That was late yesterday afternoon. We're talking about the concentration in tech, and that revolves around Meta. Delivering disappointing outlook, the plans to spend billions of AI on AI. Ed Ludlow is with me. I mean, the profits and the revenue were enviable, but this is about belief in the guidance of the dream of the founder. Good morning, Ed Ludlow.
That is a perfect summation. You know, Mark Zuckerberg says Meta can be the world's leading AI company. And the bit that the investor base didn't like was almost the roadmap to get there, not necessarily the idea that the range for expenses for the full year was slightly raised at the bottom end of the range, not that CapEx has been boosted to 40 billion at the top end. It was the explanation of how long that infrastructure investment to support AI model development is going to show up in what Facebook Meta already does, the family of apps. They're still principally an advertising company. And he got peppered with questions on the call about product cycle. So typically, if you think about the Facebook platform, WhatsApp app, the hardware business, they run 2-year product cycles, where after 2 years, you can clearly see that product showing up in revenue. But this is a direct quote from Mark Zuckerberg. The smart investor, which was a bit of a dig at the investor base. For those of you watching, reach out to me. I'd love to hear your thoughts. The smart investor will not only see the scaling of the product and they'll see the monetizable opportunity and the revenue come. The stock's down more than 15%. That puts it on track for its biggest drop since October of 2022. And it's that roadmap or product cycle that the market just doesn't believe in. And you see a number of sell-siders have cut their price targets, partly because they also wanted everything right. They wanted to see prudence. Expenses are going up, headcount's growing, and they're all in on AI.
Well, that's two CEOs that are chiding their investor base. One is, if you don't believe in my robo-taxis, get off my investor base. And the second one is, very much very disingenuous. There's some smart investors. Sometimes you need those big investors. You can find that, Ed, as you go through the cycle of life. I'll leave you with that thought. We've got Meta down 15% of the open, the biggest drop since October 2022. We'll continue on the earnings numbers. We've got a nice beat coming through from Ford, the automaker, boosted by demand for, you got it, that big old truck. Abby.
And this is an interesting one, Manus, because this stock has been flipping around in the pre-market, but it is now up more than 1%, heading to a 6th up day in a row, the longest winning streak since December of last year. So investors choosing to go with the positive messaging out of the quarter. And they did, in fact, beat adjusted earnings by about 16%, revenues in flat. It did have to do with the work truck strength. On the other hand, net income fell 24%. So I think that was part of why the stock had been down. But now investors are going with revenues, even though they were about flat or a small miss, up 36%, and plus the fatter profit margins for the commercial Ford Pro unit. So we have investors very positive on the street. Citi saying encouraging outcome. The stock right now, again, up 0.9% on the morning.
Okay, Abby, thank you very much. Abigail Doolittle on the stocks and sector watch. We'll be back in just a moment. Sticking on the earnings front, it's a roller coaster day. Caterpillar results sending a note of economic caution. It's a bellwether, delivering a disappointing outlook and a warning about the second quarter on both sales and volume. Emily Grafeo is with me with the detail, down nearly 7%. The market does not like what it hears.
Yeah, it's interesting. The stock was already up 23% year to date, so perhaps the bar was higher than normal for Caterpillar. But like you said, this is one of the biggest manufacturing companies, really a bellwether for the economy here. And they did note that they see a softening economy in the Asia-Pacific ex-China region, and they also see weakness in Europe. But North America sales seem to offset the weakness in the other regions. The company did beat on EPS, coming in at $5.60. Versus estimates of $5.13. The revenue was a slight miss here at $15.8 billion versus estimates of $16.12 billion. But again, the market really does seem to be punishing anything less than perfect in this earnings season. And they also said they expect second quarter sales to be lower year over year. That stock now down almost 8% after the bell, Manus.
Emily, thank you very much. Emily Grafeo there. A tale of two earnings within the transports. You've got Southwest Airlines and American Airlines, both under pressure. But different story for Royal Caribbean, boosting its outlook amid surging demand. I've never been on a cruise. Alex Nemenova, differentiate for me.
Good morning, Manus. Well, you can definitely say that there's something for the Bulls and something for the Bears in this morning's earnings results. We got to start with the downbeat readout from Southwest. The air carrier said that it's ending service in 4 airports, also offering voluntary leave to address significant challenges in 2024 and 2025. Those challenges created after Boeing again reduced the number of aircrafts that the carrier will receive this year. Southwest is now set to get just 20 Boeing 737 MAX jets, down from 46 previously, this is the third reduction from Boeing, highlighting the toll that the plane maker's fallout is having on one of its leading customers. Southwest had previously been known for flying an all 737 fleet, and this came along with first quarter results that fell short of Wall Street estimates. Shares are down about 9% this morning. The stock was up 1.5% year to date heading into these results. And then on the flip side, you have Royal Caribbean seeing much brighter days. It hiked its outlook as demand for cruises surges. That also prompted them to hike up prices. Earnings per share will now be between $10.70 to $10.90. That blew past the average Wall Street estimates of about $9.99. CEO Jason Liberty said that demand continues to be very robust with bookings at all-time highs. The cruise operator will also continue to raise prices as demand surges. Shares are a little changed this morning.
Okay, Alex, thank you very much. Let's turn our attention back to tech. A little bit earlier, Danny Berger and myself caught up with Nancy Tengler of Laffer Tengler Investments on the Meta earnings.
I think you can argue that he hasn't learned his lesson. We've been here before, you know, where the CapEx for the metaverse, and now we're in AI chat box spending. Whereas I think with Microsoft, the use cases are multiplying in generative AI.
Mark Lehmann of JMP Securities joins me now. Nancy was fairly direct. He hasn't learned his lesson. The year of cleaning it up in 2023 is long gone. Do you think he hasn't learned his lesson? Is there a bit of an arrogance in his presumption, I can do this CapEx and you all better pay up and listen?
It's a great question. It's the question. The question is that arrogance or is that confidence? And I think at this point with the stock down as much as it is today, the street is telling you that was a surprise. And maybe the arrogance was just assuming that, as Zuckerberg assumed, the street would take him for granted when he said he was going to slow CapEx, but just wait. You're going to want to get that reward at the end of 25 and 26. So for now, it's being punished. You've got to spend, and that investment is going to take a little bit longer, and the profits are going to take a little bit longer, too.
Well, I think really what we've got, our markets are moving from pricing genius and rewarding genius at multi-levels in Elon Musk, in Zuckerberg, etc., in founder genius to reality of delivery. But you mark down the stock, I know incrementally, your target's 525. Now, you are worried about something more fundamental, which will come through tonight. You're worried about the underlying business, the ad business. Talk me through that, because we haven't spent a lot of time on that this morning.
I think the real issue is what the ad business is going to look like and what people are going to spend for that ad business. And I think Meta is a great harbinger of the future. It tells you what the future looks like because they have so many platforms and they touch so many people. They touch 4 billion people per month across their platforms. Now, we have a big year in advertising. Obviously, we have the Olympics coming up. We have an election coming up here in the States. But the question is pricing and that price optimization that they think they will garner through AI. And I think the bears today are voting with their feet. But let's remember, stock's up a great deal year to date. It's up a lot more than the market. It's also growing almost three times as fast as the stock market is, and close to a market multiple on today's earnings. So the question is, can they perform with those earnings targets for next year? Because right now they're being much more transparent about how much investment they're going to have to make.
What I'm struggling with here is the original guidance on CapEx was 35 to 40. This year, this is the guidance. It's going to be 35 to 40 billion. Originally, that was 30 to 37 billion. Can you compute a 15% drop in Meta on the market quibbling over $3 billion?
I can. I mean, the stock, like a lot of the stock market, was priced to perfection. It was also pricing the stock when it was over 500 that there would probably be a meet and beat, and there would probably be rates that were not going to be over 5%. That was 90 days ago or 30 days ago, and a lot's changed in that short time, as we can see for the overall stock market. So things are priced to perfection, and this was by far not perfect.
And that's why there's just no room, as it were, for forgiveness. When it comes to Alphabet and Microsoft, and the narrative would be this, is that there's something much quicker and demonstrable in the AI delivery within Microsoft. They have OpenAI, they have something much more provable. Does that make Microsoft just a better alternative in this suite of AI?
It makes it a safer play. It certainly is showing the kind of fruit on the top and bottom line that investors like. Meta I mean, look at all the last 3 quarters, how fast the stock went higher and lower. You talked about October 23. I mean, the swings in that stock for such a large, trillion-dollar company is beyond any comprehension for somebody who's done this as long as I have. But I think the people who own Microsoft know what they own. And I think when you own Facebook, you own a lot bigger beta. And that's a hard thing to swallow when markets are priced to perfection.
Well, if we're priced to perfection, I look at WPP in the United Kingdom this morning talking about advertising revenues in big tech being down by 8%. That is an inauspicious background to seeing these Alphabet numbers tonight. It is going to be about core search, and it is going to be about certainly a heavy dose of AI. But WPP does not beckon a great curtain raiser, does it?
No, and listen, I think the thing that you have to look at when you see the Google numbers is what are they doing to make sure that they stay at the top of the game going forward. I think you're going to see numbers that probably are fine for what you saw in the rearview mirror, but their commentary on the future and how they're investing for the future, I think is really crucial because they have so many eyeballs and so many advertisers and they see so much. And I think to date, there's been more worry than excitement about that future. But again, they are a great demonstrator of what the market looks like. I think the overall market got very frothy, obviously, at the end of last year and the beginning of this year with such big promise for AI. That promise, I mean, we're seeing it inside Citizens every day. That promise is real. What it translates into earnings is the real question mark for the market. And today they're telling you it's not as soon as we thought.
Let's just round off with Reddit. Phenomenal community, great IPO. I'm just wondering, in rising markets, everybody wants to know a mountain of information. But it's really in falling markets that typically the higher volume goes through on a lot of these, leveraged exchanges. It's in collapsing markets probably that people want more information. Talk me through your analysis of Reddit as we close off here.
So, as you know, went public recently last quarter. Fortunately, Citizens JMP was part of that story. Our analyst Andrew Boone sees 20% growth pretty much visible in the next few months and quarters and years. And I think the market is questioning whether they can do that. Largely, investment spending has already taken place. Mm-hmm. And they have a very, very active, loyal fan base and group of people who every day are part of that community. If they can bring those loyalists down to the bottom line, and we think they can, that stock's going to be a lot higher, and it's kind of getting closer to its IPO price. But if they show that kind of visibility on earnings and growth, we think the stock's going to be very attractive here.
Okay, all eyes down on that. Mark, thank you very much, Mark Lehmann there. I just want to bring you some reaction from the White House on the GDP numbers. Obviously, GDP lower than estimated in the first quarter at 1.6%, the lowest in 2 years, and that spike in inflation. And this is what President Biden is saying today. The economy remains strong. It continued steady and stable growth. But he adds this, that more work needs to be done. We have more work to do. Costs are too high for working families, and I'm fighting to lower those. So this is a very first reaction, obviously, because the markets are convulsing. They're moving rate cuts out to December at the end of the year. Yields are higher. Stocks are lower. It's a double punch for stocks from Meta and the GDP and the inflation data. Coming up, European bank earnings, they continue to roll in.
We try to work within the rules and regulations that apply to us to be competitive on compensation, be an attractive employer across a whole range of considerations.
You got it. Banking bonuses, they're in focus. That conversation next on Bloomberg.
We operate, obviously, globally competitive markets, and anywhere where regulation, by the way, for us, it applies globally, the European regulation. And so it can put us at a competitive disadvantage. We try to work within the rules and regulations that apply to us to be competitive on compensation, be an attractive employer across a whole range of considerations. But it's certainly a concern when regulations in the US and the UK, where we are active in a number of our businesses, start to move in a way that places European competitors at disadvantage.
It's that magical word. It is all about banker bonus and compensation in focus. That was Deutsche Bank's CFO saying that the UK's decision to scrap the cap on bankers' bonuses could put the firm at a disadvantage when it's hiring. Now, those comments come after the bank's trading revenue rose more than expected and beat most of the biggest names on Wall Street. Tom Metcalf is with me now. So, two probably zeitgeist words, one for the shareholders. Let's start with that, which is buybacks, because Von Moltke talks about kicking off talks again with the regulator on buybacks. The stock's up 8%, Tom.
Yeah, and a complete reversal from earlier in the day before he made these comments where, we were scratching our heads a bit looking at Deutsche Bank shares going down despite that outperformance by their bond traders. But goes to show sort of just what's on top of investors' minds, right? Like, as soon as the word buybacks mentioned, the fact that Deutsche Bank is at least going down this process, albeit one that needs regulatory approval. I mean, look at that share price, right? Up more than 7%. And now it's overhauled Barclays, which previously was the best performing bank.
Well, I think, here's another way to frame it, which is you look at UBS perhaps facing a monumental hike in capital requirements from the regulator. That's what we heard last week. Motti and Kelleher have always been about the dividend and the buyback. It's been the holy grail within UBS. And here we are. Maybe my return on equity and my dividend and my buyback story is pivoting at Deutsche Bank on a relative sense to UBS. Just food for thought. Talk to me about bonuses, because suddenly London could be the attractive destination. I mean, they did adjust the comp in London when the bonus cap came in, which was higher regular comp to smaller bonus, but looks as if that has been upended.
Yeah, exactly. So the UK government here, one of sort of these post-Brexit dividends they love to tout, has now basically told banks, look, we no longer need to see that 2-to-1 cap that is still in place across the EU. And for a bank like Deutsche Bank, even though they've got a massive London operation, they still have to adhere to the EU cap, where basically your bonus can only be twice fixed pay. So it's really interesting to hear the CFO speak on those things, because a lot of executives on the other side of the coin, the British lenders, have said, it's almost too late now. We've kind of established this other system. Do we really want to go back and reverse it? But now they are starting to go down that path. And to hear an executive at a rival bank saying, hey, we're looking over our shoulders at this and wondering, could this be like a key sort of differentiator in that race for the top talent? It just goes to show that it's sometimes those regulatory shifts that can make all the difference.
Maybe the top talent has decided to go to Dubai. Tom, thank you very much. Tom Metcalf there. There's no income tax there at all for Europeans or Brits. Sector price action for you. Let's get to Abigail Doolittle.
Well, we are looking at a decline for the S&P 500 right now of 1.4%, largely having to do with that Meta sell-off, making the day a little bit more risk-off. Is the one sector that's higher, that is consumer staples. That's a defensive sector. So the fact that you have investors leaning toward the PepsiCos, the Procter & Gamble's, and the Walmarts of the world, again, makes this day a little bit more defensive, risk-off. You can see 10 of the 11 S&P 500 sectors are lower. Clearly, it's those mega-cap tech sectors that are down the most. In fact, we at this point have 6 sectors down more than 1%. But the communication services, and yes, that is home to Meta, down 6%, at one point down close to 7%, the worst day at that point in more than 2 years. Right now, the worst day since October of last year. This week, right now, we have this sector also heading to its worst week of the year, Manus. And actually at this point, we have just one stock that's trading up. No, all stocks within the sector are trading lower, again, headed by Meta, down 14% right now.
It's quite a monster destruction in equity value, isn't it? Abigail, thank you very much. Coming up, we'll set your events for the rest of the day. Guess what? A little bit of tech will be in your trading diary on Bloomberg. It's a gut punch, whatever way you look at it. Meta's done $170 billion in market capitalization, $178 billion in the space of 2 days. That is an inauspicious backdrop to Microsoft, Alphabet coming later on today. NASDAQ down 1.69%. And if you're hoping for rate cuts this year, dream on, because right now the market is repricing one cut, and that is by December. And that is a fading glory as well. Here's your trading diary for the rest of the week. Pending home sales come in at the top of the hour. Alphabet, Microsoft report later today after the close. And finally Friday, PCE deflator and University of Michigan sentiment hit the tape. But it is about intervention watch from the Bank of Japan. They have a rate decision tomorrow. Have we traveled sufficiently far to give us the wrath of the Ministry of Finance and the Bank of Japan. Yen is down by more than 4% in the space of 2 weeks. That is enough to irk officials at the Bank of Japan. Countdown to the open. I think we talked enough about Meta. Tomorrow, a little bit more tech for you. We'll take you through those results from Microsoft and Alphabet right here on Countdown to the Open. The team take you through the rest of the trading day from New York.